Now, Steve, this week, Federal Reserve meeting is going to be crucial and certainly looks as though they're going to be doing something.
Yeah, I think it's going to be critical, and it'll probably dictate what we see certainly for the next week or two, and maybe even for way into October.
Hello everyone and welcome to our Trader Talks videos with me, Richard Perry, market analyst at Hantech, and also Steve Miley, the market chartist. Now, as ever, if you're not trading with Hantech, you can go to hmarkets.com to sign up for a free demo account or even fund a live trading account in 4 easy steps. Now, Steve, this week, Federal Reserve meeting is going to be crucial and certainly looks as though they're going to be doing something.
Yeah, I think it's going to be critical, and it'll probably dictate what we see certainly for the next week or two, and maybe even for way into October.
Yeah, I think that what we're going to be looking at is how the Federal Reserve deals with this change in paradigm, really, with the Jackson Hole speech from Fed Chair Powell, whereby they said that they were going to start to target average inflation rates, and that really does put them on a more dovish path than the market had been sort of factoring in previously. Now, how that affects the formality of rates and monetary policy, I think going forward will be interesting.
Yeah, certainly. We were just talking off camera there earlier on. I think they keep that very dovish path. My view is they're not particularly going to give us anything more on the inflation targeting side. They're not going to nail down a number in here, and I think they'll keep it vague. The market seems to be happy with vague at the moment, so why bother not leaving it vague? And my kind of inkling, I think the outside risk is that they might actually, they've been very downbeat on the actual recovery in the economy in this, with obviously equity markets having a surging recovery, but with the actual the actual true economy recovery, and with there's talk of this K-shaped recovery, right? The stock market versus the real economy, but maybe they might see some some green shoots in here from the real economy, because some of the data's slightly better. So I think that could be the slight surprise, dovish, but kind of slightly more positive on the recovery.
So how does that fit in with your market, the S&P 500 that you're looking at?
Well, then that puts us back higher, really. And we obviously saw that significant sell-off driven by a tech rout, not really driven by any kind of real fundamentals, overbought, overstretched positioning. Tech led the way lower that we saw for the first part of September and dragged the whole risk complex down. Now the market has stabilized in here over the past 2 weeks. We had a gut check lower again last week, and the market kind of rebounded here on the S&P off of 33.10. And I think if we can clear above 32.45 in here, and we went right up close to there yesterday and didn't want to go through
34.25.
Oh, excuse me. Yes. Yes, got to get that right. 34.25. If it can clear above 34.25, then we've got kind of a little double bottom pattern there on the much shorter term chart, and that can open up upside. I think initially just back up towards the 3,500 area, but then potentially back up to the peak at 35.88.
Yeah, for me, the Fed supports the S&P 500, and ever more dovish Fed equals positivity for the S&P. You add in the potential that the economic rebound is sort of taking hold. You look at how China is developing its rebound. You had some decent trade stats, and it certainly seems as though that the retail sales are picking up, and data out of China is positive. So that's positive for global economy, and that helps the US economy as well. So I think that all sort of adds up to these green shoots that potentially are coming through, and we see that I think that the S&P 500 will benefit off that. And as you say, the technicals above 34.25, I think really does then target the highs of 35.88 again.
Yeah, agreed. And then we've got momentum supportive. You can see from the 9-day RSI coming back from, didn't really dip much below 40, pushing back towards the 50 level. Now, caveat, if the Fed don't deliver, if the Fed, either a step to even slightly hawkish, now I can't see it, but even a very slight step to hawkish, it could all fall apart for equities. So, and if we take out,
I think fall apart is a bit strong, but I'm not sure that it will be a risk that the Fed takes. I think I can't see them being dovish I can't see them being hawkish after that Jackson Hole speech. I really can't.
No, I can't. Yeah, but I mean, my main concern is if we do break down back below the lows, if we can't take out the upside 34.25, if we go back to 33.10, I think it opens the door to like 3200. Another 100 index points on the downside. I think we could see a notable correction, and maybe even deeper than that if we get any kind of panic coming. But for now, my view is positive. But I think we have to throw that in, that if that low goes, the sell-off that we saw at the beginning of September could just be the start of maybe a deeper correction.
Yeah, I just don't see the Fed drives that move. I think it would be something else.
Yeah.
Okay, so what about my chart? Well, we're looking at the
Kiwi.
The Kiwi. Obviously, it's the second chart that we got this week, and risk on, as we've said, sort of playing out for that Fed move. And I still think that the Kiwi has got some upside. It's interesting that the Kiwi has started to perform better than the Aussie. Interestingly enough, we talked about this previously, whereby I think that market's fairly comfortable with the view that the RBNZ is looking at negative rates now, and we've started to see the Kiwi climbing higher on a positive risk move, and it's performing well. And I think that the move on the breakout above 67.15 really did sort of generate the more upside move that we're going to see to 67.90. But then that's the key level of resistance. If we can break through that, with the strength of the momentum that we've got, the RSI consistently above 40, says to me that weakness is a chance to buy, and we're starting to pull higher. We've got the consistent uptrend going on, and I think that we're going to break out above that 67.90 level, and then looking towards 69.40, 69.70, which are old highs from a couple of years ago.
Yeah. I mean, I'd have to concur. What I really like about it here is your trend line in here, this redrawn trend line coming off the more recent low from August, and it holds there exactly right around 66.00. I'm springing off of there in here in the last week or so, and so that the technicals really sit with that kind of macro view as well. I think 67.90. You've got the old highs you spoke about there, and even up to psychological 70 level as well. So that's all in the risk parameters as I see going into probably late September into October for the upside for Kiwi.
Yeah, the 66 level of support is key, I think, to hold that, and then if it does hold that and the trend, then we're looking positive. Okay, thanks, Steve. Well, thank you again for another Trader Talks, and we'll speak to you again next time.
See you then. Take care.